want to talk about some risk management that we really should take into evaluation when it comes to, being in the cash flow machine. And that is when a stock starts to turn against us. Now, our job is to make sure that we got the right stock in the right market. But the right market is, really up to the rest of the market, and so is the right stock. People always ask me, why is the market down today? Or why is the stock down today? And I always have one answer. It's more sellers than buyers. And we can't do a lot of that. When an institution decides to get out of a stock, that stock can go down. So I'm going to show you the criticality of the 10-week moving average on a weekly chart or the 50-day moving average on a daily chart. They're about the same thing, give or take a day or two, and they generally track each other. But if you look at a weekly and you look at a daily, the weekly is going to take out a lot of the noise and really give you a good idea of the trend. So this stock that you're looking at on the screen right now is showing a lower left to upper right trend, but this is a weekly chart. So this is over many, many years. In fact, this is about a 5-year chart. Well, over 5 years, a lot of things get smoothed out, and this is an upwardly moving chart. The problem is at the end of the chart, it's moving down pretty significantly. You could see a few other spots in there where it's moving down. But I want to also just take a moment and show you, once we get this cross, it's a really important cross right there, where the 50-day moving average is crossing the 200-day, or this is a weekly chart, so it's the 10-week moving average crossing the 40. You'll hear me talk about them interchangeably because they're pretty close. But you'll see that stock starts to trade above that 10-week moving average pretty significantly right after this spot here, where it kind of tests this breakout move, and then it goes above it, and it stays above it for months, several months. Each 4 bars is a month, right? So 6 or 7 months, and that's a nice trend to be in. And so if you're just collecting your juice every week of 1 or 2%, over a 6-month period of time, that's a nice, 24% gain, or 48% gain if you're going for the 2%. It's these spots where it falls below the 10-week moving average where you need to be cognizant of it, because these are often signs of a bigger move down. Now, in this case, you saw a week's close above the 10-week moving average there, and then you saw a close below the 10-week moving average, and it stayed there for 5 weeks until it recovered. So then the next thing you need to do is kind of look at the volume. Is that significant volume? In this case, it was. So that could have foretold a very big downward move. It didn't in this case. But you can see that whenever you have some of these big volume, down spikes through the 10-week moving average, it's giving you some information. Like this stock it wants to be a little bit weak because it's now coming down a couple times through the 10-week moving average, but it recovers every single time. Then it goes sideways, not a very strong recovery. And then look at this, 3 weeks back down through the 10-week, and then it breached the 40-week or the 200-day moving average. That is unhealthy. When a stock starts to breach that on a regular basis once or twice, maybe it can handle it once or twice, but usually by the 3rd time it can handle it. Let's keep going forward on this analysis. So it went through the 50-day and the 200. That was a tough period of time to be in that stock. Now we're looking at a logarithmic chart, so these are showing kind of percentages. This was a big percent move. It went from this, you don't see this on the stock chart that you have, but this top here is at about 180, and this bottom is at about 150. So that's about a 25% down move. You don't want to be in that if you can help it. But if you have a long-term approach, you know that 3 weeks does not make a stock's move, and this stock is trending up, but it could have gone down lower. So you need to kind of have a rule put in, and I'm giving this up to you. At this point, if you're watching this video, you understand that stocks don't always go up. You also understand that there's volatility, which helps us when we're selling options. But you also understand that when stocks start to come down, you need to be in there for the long haul, or you need to get out. Like, you have to change your mentality, right? When stocks are going up, you don't think about that long-term mentality. You're like, woo, everything's green, I'm making money. But when stocks start to turn down and they stay turned down for a while, it can be emotionally draining. And this was only a 3-week period, but it was a 25% move. And so that consistently could have wiped out a very long move, a 3 or 4 month, 2% a week kind of a move in a matter of 3 weeks. And then you're like, oh man, I started so well, and then I gave it all back. But imagine if you started here, because it's not inconceivable that you could start here and make a case that this is above the 50-day moving average or the 10-week moving average, and everything looks good. But what if you started right here and you immediately started getting hammered 3 weeks in a row. Well, that'd be pretty tough to handle. I mean, you can sit there and justify that you're going to make 2% a week, and that's 8% a month, but that's 3 months that you would have had to wait for this thing to get even for you as it came back here. And so mentally, if you'd started there, you'd be like, wow, this is a horrible system, right? We're forgetting that this system is a longer term system, that you have to look back a year and look back over that year period and say, well, I made 2% a week for a year, that's 100% a year, or I made 1% a week for a year, that's 50% a year. But nonetheless, if you started here, it would have been pretty rough. Of course, it recovered, and then it did it again. It fell down below that 50-day moving average, that 10-week moving average, on pretty light volume though. And then so it kind of lived there a little bit, vacillated, then you had a big up volume day there, which started a beautiful uptrend for several months. You notice it didn't have a close below that 10-week moving average for several months. That was a good time to be in it. But look at this one. This was a bad time to be in it. If this breached the 50-day moving average, the 10-week moving average, and it started coming down, you would have been sitting from a $230 top here all the way down to about a $140 bottom. That's a 90-point move on a $230 stock. That's about a 40% move. That's pretty tough to handle mentally. Every single week it's relentless. The sellers are beating the buyers every single week. So let's look at the daily on this stock, and then I'm just going to go quickly start to show you some other ones. When the stock breaches the 50-day moving average, and it does it on volume, you want to know that it's doing it. And so you might even set a rule that if it closes below the 50-day moving average, you might want to get out. You might want to just buy your option back. It's probably down by now anyway, so you made a little bit of money on it. And you might want to get out because institutions support those 50-day moving averages. And so maybe you make a rule. This is optional. Like, I don't do this because I've been doing this for so long that if I pick the right stock, and that doesn't mean the right stock is always right. It just means that I have confidence that a year from now, I'm not going to lose 50 to 100% on the stock. I'm going to be confident that a year from now, I've chosen the right stock. But I'm wrong sometimes. Now, you have the choice. Get the heck out or hang in there and make your 2%. Defend your position. Keep rolling down. If you're deep enough, you're going to have fewer rolls. So if you go all the way down to where you're getting 2%, or 1% even better, you're going to have way fewer rolls. That stock might have to go down, 6 or 7% before you start to get into that protection amount. And so, but maybe you want to get out, and this is your option. This is not something where anybody else can tell you what to do. If the stock is down and you don't like to be in it, you know what? There's nothing wrong with getting out of a stock, because what you're doing is you raise cash. You're protecting the account, which is the first thing we do in the cash flow machine. If you protect your account, you can live to fight another day. But you can also sit in there and ride through this whole slogging down, this selling, and hoping that it stops. Now, in this case, it went from 215 down to 170. That's a pretty big move, too. That's a 45, 50-point move. That's pretty rough. 25% move. Look at all the selling. Almost every day was selling. So you wake up and you're like, oh my gosh, when is this selling going to be over? Well, it was over here when there was a capitulation on high volume. It's called a little kind of a hammer candle, but it was just a high volume capitulation. You could see it did 40 million shares compared to what it did, and then it just started to bounce from there. And if you were just making every week, you were just making 2%, 2%, 2%, 2%, you made 8% on the way down while you were losing 20%. Okay? So you're still down 12%, and you make another 2% here, another 2%, 2% here, and then by this period of time, you're about, let's call it even. And then you go back into your uptrend, and you're making 2%, 2%, 2%. You drop a little bit more here, and then you keep making it back up. Over time, that stored value starts to build. Watch the video on stored value. Watch the video on the seesaw between cash and your base position, and you'll see how this starts to work. So these periods of time, I look at them as opportunities. They can be opportunities to get out, but I look at them as opportunities to be able to buy my base position a little bit deeper, maybe get a higher delta on my base position if I'm using synthetics, or buy more of them so that when the stock does recover, I'm in a pretty good situation. I've got more shares, and I'm making 2% on more shares. And so that's kind of how I want you to look at it. But I want you to also look at the behavior after the stock went above its 50-day moving average here. Look at it, it stayed there for months and months. So it went from the 200s to the 300s. It made a 50% gain in several months. And if you were just making your 2% a week, you would do fine in there, right? You would do really, really well. You might have to roll your calls up, and you might have to continue to spend more money to buy them back, but that's okay. You're still making your 1 to 2% a week. And so I want you to look at this breach, though. This is a gap down, bad. Below its 15-day moving average, bad, okay? And the volume is high. So look at the volume down here. It starts to build. This is a character change in the stock. From this la 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 up and down volume to all of a sudden heavy volume every single day. Relentless selling. You don't want to be in this if you can help it. Otherwise, you just have to have that long-term view, stay deep in the money, get your 1% a week, make your trade adjustments, defend your position, know that it's going to come back, and it did, and then it'll be fine. As long as you have a good stock that you're confident in, it's making money, its sales are increasing, all of those things we like, those generally come back in to save the day as long as the stock isn't stupidly valued, okay? Let's look at some other ones, okay? Now, here's a stock that you can see. Not a great lower left to upper right chart on the daily, but the weekly shows a pretty flat, and then all of a sudden it's just a spike upwards. Now, it pretty much will look at this 10-week moving average and stay above it for a long time. It breached it here on high volume. Then it stayed below it. That's probably a sign to either get out or just be really deep in the money to be careful. And then it kind of popped back up, but now there was some selling, some selling that made this not very fun to be in. But the problem, the opportunity is this is fairly sideways selling here, right? This is a sideways range. We like sideways ranges in the cash flow machine. We don't like them to be too deep. But we don't mind a range like this because we can make our 2% a week and our base position doesn't hammer us like it does in this area right here. You see this area? If you're looking at that area, that's a hammer time, right? That's relentless selling, and it's really hard to make that back up. So let's look at the daily on this, okay? In the daily, this has gone from 320 to 254, and it trailed down. You don't want to be in this from 320 to 176. This is a downtrending stock. That's why the chart doesn't make this stock an ideal cash flow machine stock. You want it to be from lower left to upper right. If you got in it here when it gapped above here in this spot and it started to stay above this 10-week moving average, this 50-day moving average, I should say, then you were in it at a pretty good spot. And then it topped out here, right? You see where it topped out? And it was getting really radical, right? So you have, these are kind of small volatility contractions and expansions, a couple of gaps, a lot of weird gaps. This is that kind of stock. I'm not going to tell you which one it is. And then all of a sudden a gap up. And now look at the range on these stocks. This is telling you it's like a dog shaking a Raggedy Ann doll, and it's, trying to just get it out of its, if you're trying to get that out of a dog's jaw, you're going to be fighting him, right? And that's kind of what it's like. This dog is shaking his head back and forth and trying to get rid of all the weak holders. And sure enough, it went down, and then it had a bunch more gaps up here. Anyway, this is just erratic all over the place. It's giving you signals that you don't want to be in it if you can help it. Or you want to be so deep in the money that you should be protected, okay? So, what are we saying here? Well, first of all, we're saying make sure you get in stocks that have a chart that looks like this, lower left to upper right. Get in stocks that are above their 50-day moving average, especially if they're above this little green line, which is the 21-day moving average. That's really nice. That gives you kind of a little bit more comfort. But above that 50-day moving average, you can see that's where the institutions support it. When it starts to get around there, it's a threat that it goes down. And so I don't want you to be married to a stock just because you've already bought it. It's time to maybe get to another stock or just be really, really deep in the money and hold on to these stocks and just keep getting your conservative 1 to 2% a week. Don't try to get your 3 or 4 or be a hero. Just get these 1 to 2% a weeks, and then you have the decision. Get out or just be really, really conservative. And then if it does breach the 50-day moving average, now you've got a decision to make. Get out or be really, really conservative. So those positions are up to you, but I want you to know that they do show up in a lot of charts and there is a lot of support there. So now you get to make the decision next time a stock turns against you, because one will, and I want you to be ready. Hi, Mark Yagi here, wealth architect and author of this book on my covered call investing system called the Cash Flow Machine. Listen, what you just saw is just one part of creating reliable income of 2 to 4% a month from the stock market. But you know, if it were that easy, then everyone would do it, right? If you want to learn how I create investment income the right way, then you need to learn and have a system with rules and what-if strategies so that you can learn what I do when the market goes against me, what I do when the stock goes against me, how to adjust my trade so that it's always in a winning position, how much to risk, how to build a multi-million-dollar portfolio that creates income of $10,000, $20,000, or $30,000 a month in semi-passive income. And best of all, the whole cash flow machine system takes less than an hour a week to implement. Just go to cashflowmachine.io to learn more, or click this link for more videos, masterclasses, and free resources. See you there.